If a company could build forts, mint coins, and conquer trade routes, would you buy the stock? In 1602, the Dutch said yes and accidentally invented the modern stock market. Hey, it's sketch figures, where finance is sketched simply. Today, how Amsterdam's first stock market actually worked, the people who made and broke it, and one practical investing move you can use by the end. If you learned something new, tap like subscribe. There's a bonus mindset nugget at the end. Around 1600, long-distance voyages were expensive, risky, and slow. One storm could sink a year's profit. The Dutch solution was the VOC, Verenigde Oostindische Compagnie, or the United East India Company, which chartered in 1602 with monopoly rights to trade in Asia. Instead of funding one voyage at a time, citizens could buy shares in a permanent company and spread the risk. That 1602 public share issue is widely cited as the first modern IPO. Shares were transferable, so early investors didn't have to wait years for ships to return. A secondary market emerged in Amsterdam, letting people trade VOC shares with each other, basically liquidity before the word existed. This market became known as the Amsterdam Bourse, the first continuous market for equities. Important nuance: Antwerp had a purpose-built exchange building in 1531, but it focused on bills and commodities. Amsterdam's leap was making equity trading routine. The city even built a dedicated exchange, the Beurs of Hendrik de Keyser, completed 1611, with numbered columns where merchants met daily. Picture a 17th century Wall Street with better hats. Was Amsterdam definitively first? Depends what you mean. Buildings? Antwerp, 1531. An active, transferable stock market around a joint stock company? Amsterdam's VOC is the clean case study. Definitions matter. The Dutch didn't just sail better, they pooled risk better. By 1609, Amsterdam also launched the Bank of Amsterdam, Wisselbank, a public deposit bank that stabilized messy coinage and made payments reliable. That trust in money greased the wheels of share trading. Trading in VOC shares happened daily in and around the exchange. Spot trades, forward contracts, even options described in 1688 by Joseph de la Vega in Confusion de Confusions, the first book to dissect a stock market. He writes about bulls, bears, rumors, and leverage. It's shockingly modern. A merchant could pledge shares, borrow against them, or write a contract to buy or sell at a future date. When ships arrived with spices, prices moved. When they didn't, rumors moved them anyway. And the Bank of Amsterdam helped by settling large transfers in stable bank money. Not everything was written into law. A lot of this evolved extra-legally. Customs and norms traders enforced themselves before regulators caught up. Sound familiar? Markets aren't born fully formed, they iterate. Tools, like the bank, and habits, like standard contracts, co-evolve. Early VOC profits weren't immediately paid out. Shareholders complained loudly. By the 1610 to 1612 period, the company began delivering dividends, sometimes in kind, hello cloves, not just in cash. Imagine today's dividend arriving as a spice crate. Corporate governance was a work in progress. The Heeren 17th board ran a globe-spanning monopoly. Investors wanted accountability. Enter Isaac Le Maire, an ex-insider who became arguably the first short seller and an early shareholder activist. His 1609 petition blasted management. Authorities soon cracked down on naked shorting, selling shares you didn't own. Le Maire's campaign tried to push the price down to force change. The response included a 1610 ban on certain short sales. It's the 17th century version of regulators versus shorts, and it shows that markets have always been a tug-of-war between liquidity and stability. Even historians debate exactly what was banned, all shorting versus specific forward sales without ownership. Either way, the fight birthed rules, and that's part of market maturity. Dividends, activism, short selling, good or bad, they're all responses to the same thing: aligning owners, managers, and information. If you're enjoying the drama, activists, spices, and bans, tap, like, and subscribe so more people find sketch figures. You've heard the story. Tulip bulbs sold for the price of a canal house. Everyone went broke. Classic first bubble. It's the story that never dies. Recent scholarship says, complicated. Historian Anne Goldgar dug into archives and found the craze was narrower than the legend, with limited economic fallout. Some economists argue many trades were more like options than final purchases, changing the math of madness. The best data we have shows the boom in late 1636 and a price break in early February 1637, likely triggered by sprouting season revealing supply. That's not everyone lost everything. It's a thin market with sharp moves and plenty of storytelling layered on top later. The New York Fed retells eye-popping barter stories, houses for bulbs, and some outlets still call it the first big bubble. The truth is, both fear and facts traveled, then and now. Don't take market myths at face value. Ask who is telling the story and why. The Dutch Golden Age wasn't magic. It was institutions, companies with transferable shares, a steady payment system, and a rules-meet-reality culture that let innovation spread. The Bank of Amsterdam made book transfer payments in stable bank money, acting, some argue, like a proto-central bank long before the Bank of England. That trust supported deeper capital markets and international trade. With a national-scale company, VOC, and city-backed money plumbing, Amsterdam turned a regional port into Europe's financial hub. Then, over time, problems, war, governance stress, and overreach undermined both the bank and the VOC. Nothing is permanent. The VOC wasn't just a finance case study, it wielded state-like powers to make war, coin money, and colonize, leaving real human costs across Asia and Africa. Any how-they-got-rich story needs that full context. Great finance rides on trust, and trust has both technical and moral parts. So what from 1602 helps your 2025 portfolio? Lesson 1. Diversify on purpose. The VOC pooled many voyages under one share. Diversification before index funds. Today, broad funds do the same thing across companies and sectors. Lesson 2. Liquidity is a tool, not a toy. Amsterdam invented transferable shares, so investors could exit when life changed. But easy trading also invites overtrading. A calendar can be a risk tool. Decide when you rebalance, then do nothing in between. Lesson 3. Dividends and governance matter. Early shareholders fought for transparency and payouts. Managers responded. If you own shares today, skim the basics. How does this firm return cash? Dividends, buybacks, or reinvestment? And what checks exist on management? Lesson 4. Beware of great stories. Tulip tales sell books. Myths move markets. Default to show me the source. We just did. In money, behavior beats IQ. Morgan Housel's point, what you do consistently matters more than what you know occasionally. Set simple defaults that fit your life. Reduce the need for heroics. Good investing is mostly boring systems, not spicy rumors. The Dutch stock market shows how better risk sharing beats lucky voyages. Quick rewind. Pooling capital in 1602 built a market for shares. Daily trading plus bank plumbing made it hum, and rules, activism, and ethics shaped the long-run outcome. Today, this means diversify like the Dutch. Spread bets so one storm can't sink you. Use liquidity wisely. Schedule decisions. Ignore noise between. Question great stories. Seek sources, not slogans. If this helped you see markets more clearly, hit subscribe and the bell. And if you haven't already, check out our video on why money exists and how it affects your brain. This video is for education only and isn't financial advice.